When you click buy on an exchange, you think it's instantaneous. But between the moment your finger taps the screen and the moment the asset lands in your wallet, you step into an invisible war zone. Your financial intent translates into a raw data packet, broadcasting on a public ledger for the whole world to see. And lurking in the dark forest of that ledger are automated, highly complex predatory algorithms. To understand the invisible war, we first need to look at how traditional finance works. Welcome to the Centralized Order Book. This is a digital bazaar. On the left side, we have the bids, buyers shouting out the maximum price they are willing to pay for an asset. On the right, the asks, sellers declaring the absolute minimum they will accept. The gap between the highest buyer and lowest seller is called the spread. In highly liquid markets like Ethereum, this spread is minuscule. To ensure this spread stays tight, massive financial entities known as market makers step in. They deploy millions of dollars on both sides of the book simultaneously, providing deep synthetic liquidity. But what happens when a massive market buy order slams into this book? Let's say you submit a market order for 150 ETH. The order eats through the first layer of sellers instantly. Then it moves up to the next price point, and the next. You end up clearing out the order book vertically, suffering massive slippage. Your average execution price is far worse than the $3,000 you saw on the screen. Welcome to the decentralized automated market maker. Here, pricing is governed by a pure, unfeeling formula, X times Y equals constant K. Let's say a liquidity pool holds 10 Ethereum and 30,000 USDC. Multiplying these gives our constant equilibrium value, K of 300,000. Dividing the USDC by the Ethereum gives us the implied market price, exactly $3,000 per ETH. Because K must remain constant, the relationship between these assets mathematically forms a geometric curve known as a hyperbola. Now watch carefully as a whale tries to buy 2 Ethereum from this pool. The pool's ETH drops from 10 to 8. To maintain the constant K of 300,000, the pool's USDC mathematically must surge to 30,7,500. The whale was forced to deposit 7,500 USDC to extract those 2 ETH, an effective price of $3,750 per coin. The mathematical curve just punished this trade with a massive 25% slippage penalty. And this is where the real war begins. The whale's massive trade just skewed the decentralized pool, but on centralized exchanges like Binance, Ethereum is still trading at its normal $3,000. In global finance, an asset cannot have 2 wildly different prices simultaneously. This gap is an arbitrage opportunity. Automated arbitrage bots scan every exchange every millisecond. When a gap appears, they instantly buy cheap on Binance and sell into the inflated Uniswap pool, predicting a risk-free profit. Welcome to the dark forest of crypto, the mempool. This is where pending transactions wait to be confirmed by network validators. If you submit a large trade on a DEX, an MEV bot will see it pending. It pays an exorbitant bribe to cut in line, executing a buy order mere milliseconds before yours. Your order executes at the inflated price, and the precise millisecond it clears, the bot dumps its tokens back. You were legally robbed in broad daylight, enveloped in what is known as a sandwich attack. On March 11, 2023, the financial world held its breath. Silicon Valley Bank collapsed. $3.3 billion backing USDC were suddenly trapped. Fear immediately gripped the market. On centralized exchanges, overwhelming panic selling drove the USDC price down from its $1 peg, crashing to 87 cents. But the mathematical AMM curves on the blockchain are utterly blind to outside panic. They only operate on internal liquidity ratios. Predatory arbitrage bots immediately began buying cheap USDC on centralized exchanges and dumping it into the AMM pools at the old pre-crash ratio, severely draining DeFi liquidity. Amidst this chaos, one retail trader made a catastrophic mistake. Blinded by panic, they submitted a market order to swap $2 million of tokens into USDC. Because the pool's liquidity had been completely drained by arbitrageurs, the mathematical slippage was absolute. The AMM curve brutally punished the trader, returning exactly 5 cents for their $2 million. As we have seen, the liquidity war is waged not with armies but with math. Number 1. In decentralized finance, pricing is geometrical. It is governed entirely by constant product formulas. Number 2. Slippage is a mathematically guaranteed certainty. The larger your trade relative to the pool, the steeper the curve punishes you. And number 3. The market is fundamentally adversarial. If you make a mistake, an MEV bot is mathematically programmed to capitalize on it. Thank you for watching The Liquidity War. Remember, mathematics dictates the system, but you alone govern your risk.